So due to the instability of the markets lately, it's time for us to sit down and have the talk. We're going to talk about what stocks are most overvalued right now in this bull market. And I know it's not a topic people like to talk about. It's something that we like to sweep under the rug, but what stocks are most overvalued right now and susceptible to a massive correction? That is what we're going to talk about in this video, the 5 stocks that are most overvalued in my opinion. But first of all, I want to talk about what it actually means for a stock to be overvalued, and I'm going to explain it in a very simple way. I've done an entire course on this called Fundamental Stock Analysis 101. It's part of my Stock Radar membership, but I'm going to give you a very simple explanation now. When we are in a bull market, you're going to see stock prices climb higher and higher, and at a certain point in time, you reach a point where this price just doesn't make any sense. And there's a couple of valuation metrics people use to keep track of whether or not a stock is overvalued, fairly valued, or undervalued. And the metrics that I use are the price to earnings ratio, the forward PE, and then the PEG ratio. And that gives you a good idea of whether or not the valuation of this stock makes sense. And in my opinion, the valuation of these 5 stocks is completely insane. Now, I'm not saying these are bad companies to invest in. A lot of these are fantastic companies with some serious growth prospects, but unfortunately, so much of that growth has been priced into today's number that I just could not see investing in these stocks at this point in time. But if you do find that these stocks go into a correction and they go on sale, these might be great stocks to pick up on a good bargain. So the first ratio we're going to look at is the price to earnings ratio, or the PE ratio, and this is very simple to understand. You take the market price per share and divide it by the annual earnings per share, and that's going to give you the price to earnings ratio. And typically, as far as the earnings per share go, they're going to use the TTM, or 12 trailing months of data. So for example, if a company was trading at a market price of $100 per share, and they had $2 of annual earnings per share over the last 12 months, they would have a PE ratio of 50. Now, a good question you might ask is, what is a normal PE ratio? And the answer is, it depends on what industry you are looking at, because every industry has a different level of normality, or what is a normal PE ratio. So in a nutshell, you are paying $50 for $1 of company earnings, and that is why they often call the PE ratio the earnings multiple or the earnings premium. So a company with a PE ratio of 25 is significantly less expensive than a company with a PE ratio of 50. And the forward PE is very simple to understand as well. It's the exact same ratio, but instead of using the earnings per share over the last 12 months, they use the projected earnings per share over the next year, and that is all based on analyst expectations. So do keep in mind that at the end of the day, it is a Wall Street analyst's best guess as far as where this company is going in the future and what they will be seeing for earnings. And then the final ratio we're going to look at is the PEG ratio, or price to earnings to growth ratio. And this is very simple as well. You take that price to earnings ratio over the 12 trailing months that we just calculated earlier and divide it by the earnings per share growth rate over the next 5 years. And again, that is based on analyst expectations, and it's an educated guess at the end of the day. But the PEG ratio is used to determine whether or not all of the anticipated future growth is priced into today's number. Companies are all going to grow at a different rate, and unless 2 companies are growing at the exact same rate, you can't use the PE ratio alone to compare the valuation of both of these companies. But the PEG ratio factors in that anticipated growth as well, and a PEG ratio below 1 means that that stock is undervalued. If the PEG is equal to 1, then that stock is fairly valued. And if the PEG is above 1, then that stock is overvalued based on the anticipated 5-year growth of earnings per share. So now for the fun part. What are the most overvalued stocks in the market right now based on the PE ratio, the PEG ratio, and that forward PE? We're going to start with number 5, and that is Intuitive Surgical. So Intuitive Surgical trades under the symbol ISRG, and first of all, they have a PE ratio of 71. Now, despite having a forward PE of 36, which sounds reasonable, their price to earnings to growth ratio is still a 3.67. Over the last year, Intuitive Surgical stock is up 57.7%, and this stock has become significantly overvalued looking at that PEG ratio. Now, number 4 on my list is a company that a lot of people absolutely adore, but they are terrible at a very important thing, and that is actually making money. And of course, I'm talking about Tesla. They trade under the symbol TSLA. Now, Tesla does not have a PE ratio or a PEG ratio, and that is simply due to the fact that they are not currently profitable. They are not turning a profit, but they do have an impressive forward PE ratio of 110. So that means that investors are paying today $110 for $1 $1 of future earnings potential from Tesla. And again, this is a company that is not even turning a profit. Now, over the last year, Tesla stock is actually down 7.8%, but Tesla has been one of the most historically overvalued companies on the market. And number 3 on the list is Align Technology. They trade under the symbol ALGN, and they have a very impressive PE ratio of 87. Now, the forward PE ratio is 44, and they have a PEG ratio of 2.14, and that is more reasonable, but do keep in mind that is based on estimates of future earnings potential, and estimates don't always turn into a reality. Over the last year, Align Technology stock is up over 116%, and it is my opinion that this stock has become significantly overvalued. And now we get into the seriously overvalued stocks. There's 2 more on the list here, and I'm willing to bet you guys can guess exactly what 2 stocks these are. Number 2 on the list is none other than Netflix stock. They trade under the symbol NFLX. Netflix stock has an astronomical price to earnings ratio of 232 and a forward PE ratio of 68. Now, they do have a PEG ratio of 1.72, but you have to keep in mind the fact that this is one of the most loved stocks on Wall Street, and analysts have seriously high expectations for Netflix, and it's a big question out there of whether or not Netflix will be able to meet those expectations. Netflix stock has been significantly hyped over the last year or so. They're one of the favorite stocks on Wall Street, and due to that, that share price has just exploded. Over the last year, Netflix stock is up 98.8%, and a large amount of those gains took place in 2018 alone, and so this stock is definitely overvalued. And number 1 on my list, I'm pretty sure you guys guessed it, but if not, it is Amazon.com. They trade under the symbol AMZN. Just wait until you hear these numbers. Amazon has a PE ratio of 233 with a forward PE ratio of 93 and a price to earnings to growth ratio of 7.5. Remember, the further that number gets above 1, the more overvalued that stock is, and so we can tell looking at that PEG ratio that Amazon stock is significantly overvalued. But again, it's due to the fact that this is one of the darlings of Wall Street. It's a stock that everyone loves, and they are just dominating right now. But that share price is very expensive. That PE ratio and forward PE is something that is very difficult to look past as an investor, and in my opinion, it is one of the most overvalued, if not the most overvalued stock on the market right now. And over the last year, Amazon stock is up 67.8%. Now, am I saying these stocks are going to go into a sell-off right now? Absolutely not. These stocks belong on this list for a reason. They are great companies that have serious growth potential, but so much of that future growth is priced into today's number. It makes investors like me very uncomfortable. But for the time being, these are the 5 most overvalued stocks on the market, in my opinion. But anyways, guys, that's going to wrap it up for this video. Let me know what you think of this in the comment section below. Do you agree with my picks or do you disagree? And if you're new to my channel, make sure you subscribe to be notified of any future uploads, and as always, I thank you for taking the time to watch this video. If you are interested in learning more about investing in the stock market, I've created a free course just for you. The link is in the description below. Here are a few other videos you might enjoy as well.